Saturday, July 26th, and welcome to Quantaraxia's market dashboard. So we won't wait much longer. It was a positive week for equities with new highs. We even have Bitcoin hitting new highs before receding. Gold suffered a little bit more, but what we can see here is both equities and bonds going up this week in tandem, together. Which means to me that at this time, we don't have, and we've discussed this at length, the negative correlation between equities and bonds. And it seems that now they are moving together based on the assessment of the global situation of the US economy at this time. It's improving, the sentiment is improving, equities and bonds are going up. Sentiment is not improving, and both are going down. At the same time, the US dollar is slightly down. Again, we'll discuss that slightly later. And gold is down, and there was a little bit of volatility on Bitcoin, which is nearly flat for the week. Last thing we can say on oil is the drop in the market activity on oil, despite muted variations, 1.5% on oil, considering its natural volatility, is not much. But this comes in a context where the conflict between Israel and Iran is of lower intensity, and we are moving towards a resolution on the tariff side. So here we can see US equities, the S&P 500 and the VIX. We see that VIX, the US equities is reaching new highs, and the VIX is being crushed to quite significant low. We have to not forget that volatility is a breathing asset. Volatility, and it goes always from volatility compression to volatility expansion. So this is where we are now in period of volatility compression. And if we look at 1 year annualized volatilities, the volatility in Bitcoin, which is going down pretty significantly, we saw that once the ETF was introduced, Bitcoin volatility was rising despite institutional involvement in the asset class, but now it's lowering, which again means for investors that are implementing some risk parity allocation, exposure to Bitcoin should be increasing. Theoretically, probably most of them will be reluctant to do so, but if you would follow exactly some risk allocation parity, that's what you would do. And if we look at risk-adjusted momentum, the 1 year risk-adjusted momentum, we see that with the volatility, the US equity volatility dropping, the risk-adjusted momentum is still rising. We have momentum in gold that is slightly decreasing, and with the drop in volatility in oil that I mentioned at the very beginning, the risk-adjusted momentum on oil is increasing as well. So if we look at equities, we've discussed a lot since the beginning of this year about the overperformance of foreign equity markets, and we see that this week this is still the case. We have, despite a quite good week on US equities, foreign equities such as EFA, which is world equities ex US, and European equities overperforming the US equity markets. I think there are two components in this, which is linked to the weakness of the US dollar. You have to understand that for foreign investors, they are pricing their gains in their local currency. And if you look at the S&P or even the Qs expressed in euro, for instance, because of the weakness of the dollar, they have not past their all-time highs when the European equities and usually equity indices in their local currency have already surpassed their all-time highs, which means that for foreign investor it's at this time more interesting to invest in their own local equity index rather than the US equity index. This can change if the dollar recovers or if the US equity market is significantly overperforming other markets in the world. So here, this is a focus on US equity markets only. We can see that the Qs is leading the way, followed by the S&P. The two laggings are the Dow Jones Industrial and the small caps that have been lagging for quite some time. And this is what we can see here. So this is the S&P again in gray, and all other indices versus the S&P. You know that I like to look at relative value charts. And for instance, what was interesting this week is that despite the beta of the Qs versus the S&P, the tech sector is not overperforming anymore. The larger index, the S&P 500, for about 2, 3, 4, 5 weeks, they move in tandem, where the industrials are still lagging and the small caps stay stuck at the bottom where they are. So what I wanted to show you specifically about the equity markets is these two little statistics. One is coming from Bank of America and the other one from ETF provider. And what it shows is that when the retail is still buying the US market, institutional are not doing much. You know, some are buying, selling, but institutionals are dropping US equities by quite a large amount. And this is usually the kind of see historically. It doesn't mean that it will happen again this time. You have to look at the disclaimer that is, you know, the banner that is running at the bottom of the screen. But it's usually that kind of thing that happen at the top of market. And another thing that shows the risk, the current risk is the market, is again the hyper concentration in one single sector. And the concentration in the tech sector is still growing. We are now in the S&P 500, 46%. So the tech sector represents 46% of the global index. When 54% basically is the rest. And if we look at this tech sector, within the tech sector itself, the concentration is made on a very limited number of stocks, you know, max 7 plus or something like this. But there's a huge concentration is in the equity, US equity markets on a very limited number of stocks, which increase the global risk. Another little statistic about the current risk that is in the market. At the bottom, we have the average tech stock implied volatility, which is at its lowest, which indicates specifically for the tech sector a high level of complacency from market actors, especially before the earnings that are coming this week or the next. And the second point that I wanted to show you is another statistics, which is the average pairwise correlation in the S&P 500, which is very low at this time, which means that when the market is going up, the breadth within the market is pretty large. You know, the market is not moving like one single guy. There are a lot of dispersion between the the stocks included in the index, we've seen that it's pulled by a pretty limited number of names in this index, but this is not something that is, you know, fully consistent. So the rise might be weaker than it looks on the surface, which is again another risk sign on the US equity markets at this time. We see on the activity ratios that all activity ratios are dropping. The S&P activity ratios, it has fallen like a rock very significantly. Like I mentioned at the beginning, activity ratio on oil is dropping as well. Again, volatility is a breathing asset going from contraction to expansion. So anytime it's very low, it's something to take into consideration and to monitor. So there's no, you know, there's no surprise to see that the global average activity ratio being at some of their lowest level. I've shown this since 2008. It's very easy to recognize some of the crisis that we've experienced since 2008, so the 2008 itself, 2011, 2015, the Volmageddon, which is, you know, kind of muted here, but we can see it, 2018, we can see the COVID crisis in 2020, we can see the inflation as well, and we can see the tariff crisis. So my point being is that we are at low levels of market activity at this time again, and it goes back and forth. So when you are at low level, you have to be worried about activity coming back in the market, and we are at very high level. Maybe it's time to think about this is a counter indicator, if you like. And we're going to the average pairwise correlation, which again is low, which means that the perceived risk in the market at this time is pretty low. But we know that, you know, this can change very rapidly when the crisis rise. The average pairwise correlation can rise very rapidly, and this is again where we can see again the crisis that we had in 2008, specifically in 2015. We see basically all the major crises until the last one in red, which is the tariff crisis in April. And finally, the greed fear index, which is around, you know, mid-level. You would expect this to be slightly more tilted toward the greed, considering the all-time highs, considering the low volatility, considering low activity ratios. Again, this is something that can be improved, but this is I would say this is still a neutral position at this time. We don't see crazy, very high speed rise in the equity markets. We are still not at the lowest VIX index levels. So this still kind of makes sense to have a greed fear index that is not in the fear area or not in the greed area. And this is how I read this index. When it's not in the fear or greed, basically I don't really pay attention on it. But when it's in the fear region or in the greed region, this is when we should take a look. So neutral for now. And I think we're done for this Quantaraxia market dashboard for this week. You know, if quantitatively everything looks kind of quiet at this time, we know again that we are going to enter into August, lower level of volumes in the market. We are at low level activities. This is always a time when we have shenanigans basically happening in the market. So we have to be very cautious about what can be happening during these months. Usually August and September can be a little hectic. But if you read the Croissant Files newsletter on LinkedIn, that you'll be able to find the link below. You will know. I will tell you how, even if this looks good on the surface, below the surface, this is not exactly a rosy situation. So thank you for following. Take a look at the Croissant Files newsletter, unless you have already seen it, of course, and otherwise enjoy your weekend and see you next week. Bye bye.